Welcome back, traders, to Module 3, Lesson 4, Seasonality. In this lesson, we're going to explore a powerful yet often overlooked tool in market analysis, seasonality. Understanding seasonal trends can give us an edge by revealing recurring cycles and patterns that influence price movements across different asset classes. We'll start by introducing the concept of seasonality, explaining what it is and why it matters. Then we'll dive into how cycles and patterns emerge in the markets and how recognizing them can help us identifying high probability trading opportunities. Next, we'll introduce the seasonality indicator, our key tool for visualizing these recurring trends and integrating them into our strategy. Finally, we'll apply everything we've learned to the charts so you can see seasonality in action and understand its strengths and limitations. By the end of this lesson, you will have a clear framework for using seasonality to fine-tune your market bias and improve your decision-making. Let's get started. Let's begin by understanding the importance of seasonality, not just in trading, but in life itself. Seasons exist everywhere around us. Nature follows distinct patterns: spring, summer, fall, and winter. Even our lives can be divided into seasons with recurring themes and cycles. These patterns aren't random. They're driven by underlying forces and follow predictable rhythms. The same is true for the markets. Over time, we observe that markets have their own seasonal patterns, recurring behaviors during specific periods that repeat with high probability. These patterns give us the ability to anticipate when certain market trends are more likely to occur. Most importantly, seasonality provides forward guidance, a kind of annual roadmap that traders can use to prepare for high probability opportunities. It answers the when question in trading, helping us determine the most likely windows for bullish or bearish movements. In the next slide, we'll explore how we use seasonality to develop this time-based roadmap and apply it practically in our analysis. So how can we best incorporate seasonality into our trading strategy? By analyzing historical data, seasonality helps us in two ways. It allows us to define specific periods to be a bull or a bear. We use it to pinpoint windows of time when markets are more likely to trend higher or lower. By identifying historical patterns of growth and decline, we will be able to establish recurring cycles which provide a reliable framework to refine our strategy around predictable time-based trends. With the help of seasonality, we can develop a forward-looking time-based framework allowing us to anticipate market movements with greater confidence, aligning our strategy with historical probabilities. Let's now take a moment to explore the mechanisms behind seasonality so that we have a clear understanding of how the data is calculated. To understand how seasonality works, we first need to look at its foundation: historical averages of past trading days. Seasonality analyzes how an asset has performed during specific timeframes, whether certain days, weeks, or months, by studying historical trends over a set number of years. For example, we might ask, how has this market performed in April over the past 10 years? By averaging past performance, we uncover recurring seasonal tendencies that can provide forward guidance for future price movements. A key component of this process is the look-back period, which determines how much historical data we analyze. We recommend using 5, 10, or 15-year lookbacks for the best balance of relevance and reliability. Keep in mind that shorter periods, for example 3 years, can overemphasize recent anomalies, making the data unreliable. Conversely, very long periods, more than 20 years for example, may capture outdated trends that no longer reflect today's market dynamics. It is also important to point out that seasonality is probabilistic, not predictive. It doesn't guarantee outcomes, but instead highlights what is more likely to happen based on historical trends. Lastly, seasonal patterns can evolve as market conditions change. While seasonality provides a structured, time-based framework for identifying high probability opportunities, it should always be combined with supply and demand and our other fundamental tools for a comprehensive trading strategy. Let's now jump into the charts for some practical examples. Hi, welcome back to another practical application session. Today, I want to talk to you about seasonality and the seasonality indicator. Let's have a look at the charts and see how to install the indicator and how to use it. So right now, I'm in Campus Fund, our trading platform. It runs on TradingView, by the way. To load the indicator, let's first make sure that we're on a daily chart. Remember from the COT, for example, we needed a weekly chart. The valuation and the seasonality indicator, they run best on a daily chart. So always make sure that you have the right time frame for the right indicator. So I'm already on the daily chart and I'm looking at sugar here. Next, I'm going to head over to the indicator section and I'm going to look for the OTC true seasonality. There might be a version number here. Yours might be different. Honestly, it doesn't matter. Click once to load it and then close this window. Now, you can see the indicators already loaded into the charts. We have this gray line down here, which then changes to orange. And I'll explain why the color changes in just a second. Before I show you how to use the indicator, let's take a moment to go over the settings, because there are two that we need to understand and have a closer look at. To open the settings, just double click on the line, and then you see this new window here. As with all our indicators, if you go to Style, you can change the colors and decide whether or not you want to see labels and price lines. That's completely up to you. I leave everything as is for now. What is more important is the input section here, in particular, these two fields here at the top. Notice there are two numbers that you can change. One says average years, and the other one project number bars into the future. So what does that mean? Let's start with the first one, the average years. Remember from the class that we said that seasonality works by looking back in time at historical data? Well, this is exactly what you're doing right here. Right here in this particular setting, you're telling the indicator just how far back it should look. So right now, it's set to 5 years. Down here, the project number of bars into the future tells the indicator just how far ahead it should think and how far ahead it should display future price predictions. And that's where also the change in color comes in. Everything that you see in gray at the moment is past data. Everything that is in orange is a projection into the future. You might wonder now, okay, what should I select here? For the projection into the future, that is completely up to you, just how much data you want to load. I usually do anything between 1 to 3 months. So right now I have it set on 45 days. For the year look back, there we are a little bit more limited. While you are technically free to choose whatever you want, a lot of numbers probably won't make a lot of sense. Again, remember from the lessons, we talked about that if you include too many years in your look back period, you run the risk of including data that is not really relevant anymore because seasonality has moved on and the cycles and patterns may have changed. If you include too few years, every day has a significant impact on the overall average. So meaning if there was a year that was particular volatile, so like an outlier, it might then have too big of a weight in the indicator and distort it. So that's why we usually recommend to choose anything between 5, 10, or 15 years. For now, I'm just going to go ahead and change this to 10. This is what we use for most of our times. Let me change this to 10 now, and then just click on OK. Now, if you want, you can also load the indicator again a second time into the charts and set maybe there on 10 or 15 years, or 5 or 15 years, if you want to have multiple lookback periods running at the same time. Again, it's not a requirement, it's completely up to you. In order to backtest, it helps to zoom out like this, just to make the chart a little bit smaller. It just shows you a lot easier these different cyclical patterns down here, which is what we want to identify. Now, before we start with the backtesting, just an important heads up. You need to be careful with the scale. You can manipulate the scale by moving your mouse up and down here, but that's not really advisable because, as you can see, if I make the scale too small, we don't really see any cyclical patterns anymore because it's just a flat line. Conversely, if you make it too large, so if you kind of zoom in too much, then every small move looks like a super strong move here in the cyclical pattern, and you might see stuff or identify patterns that actually don't exist. So always keep it on auto scale. If you accidentally move the scale, just double click on it and it resets to auto scaling. Now, I've already put some lines in here just to show you a little bit of a backtesting exercise. So what I've done is I went back in time and I looked for sharp changes in the seasonality here. So for example, here at the end of Feb, you can see that seasonality was trending upwards and then it sharply went downwards. The same thing happened in February here in 2022, in 2021, in 2020, and also here in 2019. So these are the kind of patterns that you want to look out for when you do backtesting. You don't want to look at smaller changes. You want to look at the obvious ones, the extremes. Same like I did here, the ones that really stand out. Now, let's have a look at the chart at price and see what happened. Let's start here with February 2023. And I'm going to zoom in just to make it a little bit easier for us to see what happened. So you can see that the indicator, if I'm being accurate, actually here on the 23rd of Feb, it told us that we are now expecting a bearish move in the market. And that's exactly what happened 2 days later. The market started actually to decline the next day. It then rallied up a little bit before it collapsed. Next, here in 2020, again, it was around the 23rd of Feb, the market actually started to collapse exactly the next day. So the indicator here was very accurate. Let's keep going. We can see here in February of 2021, actually the top was right here. Again, it was the 23rd. We can see that price topped out before it eventually collapsed. And the same thing happened in 2020 and in 2019. So you can see the indicator had a very high reliability rate here. Every time it told us it would top out in February, we got a subsequent sell-off. So where does it leave us now? Well, if we now look into our future projection, we can see that also for February of this year, the seasonality indicator shows us that there is most likely going to be a bearish pattern to come. So how do we act on that? What do we do next? Do we just go in market short towards the end of February? Of course not, right? We need to always make sure that we align what we see on one indicator with other fundamentals in supply and demand. Meaning, right now, we know what's going to most likely happen in the future. So we can prepare for it. We kind of have a roadmap now. We know, okay, if we are in February and we're heading towards the end of February, we should take a closer look at sugar because it usually tends to sell off. We then should look at our other indicators to see if they support a bearish momentum in the market, and then find a high quality supply zone to place our trades accordingly. Remember, seasonality is not a standalone tool. We always use it as part of our wide arsenal of tools available to conduct a trade. And it's not a self-fulfilling prophecy, meaning that just because it tells us now there is a high probability that sugar will sell off in February, it's not a guarantee, right? You will find years where the indicator showed you a bullish move, but a bearish move might have happened. At the end, it is an average. And there will be years where the market is bullish, and there will be more years where the market was bearish. And that's why sugar is supposed to sell off in February. Now with that, I conclude the practical application. I hope you learned now how to use the indicator, understand the most important settings. I'm looking forward to seeing the next practical application. Now that you've seen how seasonality works, it's just as important to understand its limitations. While seasonality is a powerful tool for identifying high probability market trends, it's not infallible and should always be used in the right context. One major limitation is that shorter look-back periods can be vulnerable to outliers. If an unusual event, like a major financial crisis or extreme geopolitical conditions, happen within a short time frame, it could distort the seasonal pattern and give a misleading signal. That's why it's critical to consider what's included in the look-back period. For example, does the dataset contain unusual market conditions such as the COVID pandemic or unprecedented central bank interventions? If so, those events could skew the seasonality data and must be accounted for in analysis. At the same time, using excessively long look-back periods has its own risks. Markets evolve and economic cycles change, so patterns that worked 20-30 years ago may no longer be relevant in today's environment. That's why we focus on balanced look-back periods, long enough to capture trends, but not so long that they lose relevance. Another key takeaway to be mindful of is that seasonality is not a standalone tool. It should always be combined with technicals and other fundamentals. Seasonality helps us answer when, but it does not determine price targets or trade setup on its own. Additionally, macro events and fundamental shifts can disrupt seasonal trends. If a major supply chain crisis, interest rate policy change, or geopolitical event occurs, it can override historical seasonal tendencies, sometimes completely negating them. Seasonality is not a self-fulfilling prophecy. Lastly, not all assets exhibit consistent seasonality. Some markets, like palladium or natural gas, are highly volatile and subject to extreme price swings, making their seasonal patterns unreliable. In cases like these, it's better to rely on other fundamental indicators. The bottom line, seasonality is a valuable tool, but it works best when combined with a broader trading framework, helping us time opportunities while ensuring we remain adaptable to changing market conditions. Let's wrap up this lesson with a quick recap of seasonality and how it fits into our trading strategy. Seasonality is a time-based framework that helps identify high probability windows for bullish, bearish, or neutral trends. By analyzing historical patterns, we gain insights into when market conditions are most favorable for potential moves. However, seasonality is a timing tool, not a standalone strategy. To be effective, it must be combined with fundamental analysis, technicals, or other indicators to confirm trade setups and refine execution. Since seasonality is based on historical data, outliers and evolving market conditions can impact its accuracy. That's why it's essential to review the look-back period carefully, including or excluding major events like financial crises or policy shifts that can significantly influence the results. We use seasonality as an enhancement, not a guarantee. It helps you align trades with historically favorable conditions and provides forward guidance and a game plan for the foreseeable future. If you have any questions or want to deepen your understanding of seasonality and how to apply it effectively in your trading routine, be sure to join our weekly live practical application classes. These sessions provide a hands-on approach allowing you to see real-time examples and ask any questions you may have. Head over to the calendar section of the website for exact dates and timings. I look forward to seeing you there.